Steve, Jim.
Is that Mark?
Mark, how are you?
Good,
What's
good.
up, man?
Hey, Hudge. Good to see you, David. Good to see you, Carrie.
Hey,
What's going on, gentlemen?
Hutch and David, how's it going?
You're all like my
Great.
my people right here.
I know.
I
so
know.
fun.
It's been a while. It's a reunion for me. I haven't seen you
Yeah.
guys.
Me too.
Yeah, it has been a while since all of us have been on a call together. It feels good.
Yes.
So we'll, if you guys want, talk amongst yourselves about whatever you want, and we'll wait a few minutes here for everyone to get on. I know there's going to be some people on that can't stay for the full time. They have other commitments and are going to have to jump. So we're going to try to get started on time and really let the Fairwinds team get right to it, so that and we are recording. So if you do have to jump, we'll be able to send you the recording so that you can catch up. So and I'm just going to keep admitting people. So Jonathan, anytime you guys want to take over the screen and get started, or Corey, whomever is going to, feel free.
Thanks, Jim. It's going to be me. Let me just pull everything up and then I'll start here in a couple minutes.
So for everyone that just came in the room, we're just waiting for Jonathan to get his computer sorted, and we'll get started right away, because I know some of you can't be on for the full time. So we want to try to make best use of time as we can. And we are recording, so we will send everyone out a copy of the recording also.
Come on, spinning circle of death.
It's not a great time for that to happen, Jonathan.
Oh,
We might have to pivot to Corey.
all right, here we go. Bam.
Jim, I need to talk to you at some time this week.
I think, hold on just a second, Daryl. As soon as we get off of this call, Daryl,
Okay.
We'll do it.
Oh, I may not have to, because I have a 3 o'clock, but
Well, let's see
somehow
how.
I got to get you.
Yeah, I've got a 2:30, so we'll see how it goes.
Sounds good. Okay.
All right. Hello, everybody. I'm Jonathan New. I'm the director of Fairwinds Capital. I'm here to present the Country Club, which is a 134-unit B-class property in Houston, Texas. It's specifically in the Spring area of North Houston. I'm going to introduce my team, talk about the deal very briefly, because we're all experienced multifamily investors here. So I'm not going to go through every single slide, but I'm going to talk about it in broad stroke detail here for you guys. All right, so we're looking at the returns here, 17.5% IRR. We're modeling higher than that into the low 20s, but we're only targeting the 17. It's going to be an 8 pref with 65% of the capital return at year 3, with a hold of 5 years. in between 3 and 7 years, depending on the market, really. But we're targeting a 5-year exit. And it is a value add play here for accredited investors. Confidentiality disclosure, which is, I'm sure, very similar to everybody else's pitch decks. A bit about us, military. I'm in the Navy. I'm a commander in the Navy. Corey's retired. Vadim's still in the Navy. And I start my very last job in the Navy tomorrow. This is the board of directors. And I think that we are all here with the exception of Vadim, who is on a ship. This has not been updated because Melvin, the only thing is that's I need to update is Melvin is our SEC attorney. He is not a part of the GP here. The co-sponsors with us is Jim, Kimra, and Julie. And Julie should be here as well. And obviously everybody knows Jim. I'm sure everybody knows Julie. And Kimra is the CEO of Vicinity Living. She's going to be doing our property management. She's also going to be doing, she did all the due diligence as well as doing the renovation project. For our operations team, Joe Belady, who's also on GOB, he's going to be the key point for asset management. Realistically, it's going to be the board of directors plus Joe. We're all going to be doing the main work of the asset management. For the actual GP team, this includes Jim, Kimra, and Julie, as well as all of the Fairwinds projects we've done. Jim is awesome. For the capital raise, we're looking at 6.04 million to get to where we need to be, but we're bringing in a lot of pref equity to eat most of that raise. We're looking at a total raise of about 1.8 to 2.2, depending on what the actual pref equity terms come back at towards the end of this week. It is going to be an 80-20 split. So it's a waterfall, the 8% pref. 80-20 split up to 18%, and then 50-50 after we eclipse the 18% IRR. There we go. So we do have 3 classes of investors, Class A, B, and then the GP of Class C. So our Class A shares are going to be, it's going to be 10% for the first 3 years, and then when we return 65% of their capital in year 3, then it drops down to 75% of what they were achieving. For our Class B shares, it's just like I talked about, it's what everybody's used to. It's the 8 pref, and then the 80-20 up to 18, and then 50-50 after that. For our waterfall, it's a pretty simple waterfall, just to incentivize the performance of the project. For our business plan, we intend to renovate all 134 units up to, we're going to kiss that A-class renovation. So we're going from kind of low bottom of the market for Bs. It's a B class, it's a low B class where it is right now and is in a B area. And we are going to take it up to maximize what we're able to get from it. That's going to take, we're modeling out for 2 years to be able to do that and get to the point where we are in the neighborhood of stabilized by year 3. We are modeling out to refinance at year 3 and then sell at year 5. So total income for the project is $343 below market. That's with other income associated in there as well. The actual rents are $243 below, or $234 below market, what it will be when we renovate. So other income producing strategies that we're looking at doing is the mail box parcels, like having a parcel within a parcel distribution program that's going to be inside the office. That's going to be a charge of premium there. We're looking at the possibility of doing entertainment packages, bulk, wireless, and cable packages. But we don't have that into our underwriting. So if we do that, when we do that, it's going to be like a bonus cherry on top. And then utility bill back, we're aiming to get up to 88% of the water and electricity billed back from the tenants. They currently already do, it's like 60% of the rubs. We just want to increase that to what it should be, what market standard is for Houston. Scope of the work, $4.11 million worth of renovations that we're going to be doing with this place. Roofs, HVAC compressors, all interior. It's going to be the granite LVP, cabinets, hardware, stainless steel appliances, and then making sure that each unit has washer and dryers, so that where we can get up to that top of the market budget or rents. The boilers, they're okay. They're in okay condition, but we're just going to continue to improve the bones of the property, and we're going to make sure that all the amenities are tip-top shape to bring in family quality of tenant base. The current tenant base is just fine, but we want to make sure that the tip-top of all our tenants are coming into our place. Security cameras, they do have some security cameras on site, but they are not being watched at all. And then energy conservation, LEDs, water conservations. It's going to drop our utilities, but we're still looking to do the roads. So here's what it looks like now. This laundry facility is going to go away. We're getting laundry into the units. This is going to become a fitness center. This old tired playground area, it's nice. We saw some kids on it, but you know, it could be a lot better. Looking at the interior of the unit, it's the laminate countertops, black appliances, even the white. We want it to just be top of the market for our tenants. For the common areas here, we're going to be adding lighting, security cameras. We're going to be rebranding the look of the property. Cameron's currently working on some renderings for what the exterior is going to look like. The hardy board that you see right here, it's all in good shape, but we're still budgeting for some like onesie twosie replacements as we find them. We're also going to repaint the exterior of it. It's going to look brand new, awesome. You can see the railing here needs to be replaced in spots. Again, the fitness center is going into those laundry space. The fencing looks like garbage, so we're going to redo all of that exterior fencing. And you can see up here that the drainage, it just goes right to the bottom, the base of the property. We're going to be moving that out from the base. We had it completely inspected. It's the base, the foundation's in great shape. Despite that drainage problem, we're just going to button it up and make sure it's good. And then this is kind of what we're envisioning it to look like on the back end. Not exactly that play area, even though that's awesome. My kids would love it. But something like that. This is what the interior is going to look like, fitness center, security cameras, and some of the ideas that we're thinking about with this like gray and wood on trend stuff. We're going to put a new sign in there. The wrought iron is going to be in tip-top shape, and then the fencing for the exterior. For our capital stack breakdown, just to make sure it all adds up, we're looking at, like I said, about $1.8 million for the total raise. And how we're structuring this capital stack, we are going with Bank Corp for our senior debt. They are giving us 11.1 million towards the purchase price and 100% of the rehab. It's like right at 4% interest rate, and 3 years of IO. It's a 3 + 1 + 1, so that we have the 2 years of extensions possible. And then our pref equity covers up to 90% of the equity stack, the entire equity stack. We just haven't had those terms back. Most likely it'll stack in between 85 and 90% of the total equity stack. They get anywhere between 7 to 8.5 of a pref return. So they get paid first before our common equity gets paid. So I say right here, between 8.5 pref return and then bought out at 14% IRR. It's going to end up coming short of that. So they're more than likely going to eat the first 7% and bought out at 12. So our modeling is light for our common equity. So it's actually going to be a little bit better. I am anticipating a refinance at year 3 at 75% LTV and then an increase of interest rates. For our fees, acquisition, market stuff, acquisition fee 2%, construction 5% of the budget, asset management 2%, and disposition at the end at 2%. For the senior debt, the GP does have to come up with 10%. We do have the equity split is set up so that we're incentivized to make it as good of a project as possible. And obviously we do include a guarantee, our personal guarantee on the loan. So everything is on our shoulders. So we definitely have skin in the game. And then the LP is always first. We've set it up to where they're great. For vacancy, we want to make sure that our being conservative with our economic vacancy, specifically considering we do have a very high load of what we're doing for renovations, all 134 units. So we're starting off with above 25% economic vacancy in the first year, and then stabilizing it at 11.5% by year 3. And then while Houston does have a rent growth of 3.5% every year, we're only doing 3% for the rent growth in year 1 with all the other income at 2%, and then 1.5% expenses on the expenses. This is just an example of what the cash flow would look like for the common equity, with blue being Class A and orange being Class B. Some basic facts about the property: mostly 2-bedroom, which is another fits into our core values for family in Fairwinds. Houston's a great market. A lot of people are a fan of it. 4th largest city in the country. It's growing both in population and jobs and rent. And then we made sure that the average household can afford the target rents that we're going after, and that it is more expensive to buy a house than it is to rent. Just an idea of where the property is within Houston. And then kind of a more micro look. It's by, Starbucks, Kroger, Planet Fitness. It's right here next to the interstate, and the airport is 5 miles just southeast of the property. And then it is right here next to all these medical facilities. And that is another cherry on top that we're not modeling, is the possibility of intermediate term rents towards like traveling nurses and people like that. Some of the companies that are invested and located within the Houston market. And then of course, we're thinking about taxes with a cost seg and bonus depreciation. We've got that into our modeling as well. That'll start as soon as we take possession of the property in the beginning of November. Different ways to invest. It's a 506C, so accredited only. And then if you have any questions, here is my contact information as well as our website. And that is all I have. Pending further questions. I can reshare the screen if you have questions about very specific slides.
Hey, just a real quick question to clarify. We are a 506C, but is your fund also investing in this deal? And if so, are they accepting non-accredited investors into the fund?
Our fund absolutely is investing in it, but at the moment we are only for accredited investors.
Yeah, that was my questions too. So there's no way for non-accredited investors to invest in the deal through any other structures?
No, not at this time, but there is a possibility that we could open up like GP spot if the investment was large enough, possible, but I'd have to talk to the SET attorneys to make
Yeah.
sure it's on the up and up.
Okay. And you said the raise right now that you're looking from LP side is 6.6 million. Is that correct?
0.06. Yeah,
How much?
just a little bit over 6.
Okay.
That includes the preferred equity though.
Yeah, and I want to clarify on the pref equity. So we are looking at, private equity as an option on this deal. But, this is the first time that we've used them. So we don't know how they're going to perform. And in my mind, when you're raising capital, it's first come, first serve. So, we wanted to present this opportunity to everyone. And give everyone the chance to get in on the deal as a capital raiser on the GP team. So if you are interested, if you have questions, please ask. Let's try to clarify as many things as we can for you, because any question that you have, someone else probably has it too. And we'll get that all on the recording and give everyone the opportunity to get their questions asked. But I do want to clarify that it's first come, first serve. So if you're interested and you think you have some people, let's have that conversation sooner rather than later.
So how much of the pref equity are you guys asking right now with the 6 million that you have to raise?
So we're anticipating getting anywhere between 4.5 to 5.3.
And the closing date is when?
Closing date currently is October 11th, but we have gotten the 30-day extension to November the 11th, but we're targeting like the 5th of November.
Okay.
From a business plan perspective, on a 3 to 5 year exit or 5-year exit, what are your thoughts? Any concerns about renovating 100% of the units versus 50 to 60% to ensure a strong exit? Do you feel as though you're limiting your buyer's pool on the back end?
No, we absolutely thought about that. We absolutely going to look at when we finish. So Kimra is looking at doing 5 to 6 units per month. She can do more than that. So once we start to get data points of what we're achieving, then we absolutely will be looking to see what the exit is at year 1, year 2, year 3, to make sure that we do have that exit strategy strong. So we do leave meat on the bone for the next buyer. But for the moment, we are modeling out like kind of not worst case scenario, but at the same.
To add on to that, you want to, if you have a change in plan where you realize the amount of money that you can make or improve for your investors, or the impact you can make to the property with renovating everything, you don't want to then have to go back and try to raise and bring in additional capital. So if there's a possibility that you want to renovate all the units, you want to plan that for that upfront and basically raise that money so it's available. And then you can adjust, if you've already taken into account that contingency of basically competing all the units. And then if you don't necessarily get to all the units, then it's okay, but it's better off than not wanting to complete all the units and then get into a point when you realize like, hey, maybe this makes sense to complete all the units.
Understood. Thank you. Yeah, from a CapEx budget perspective, totally makes sense to have it all on hand and return it if unused. I was just curious if it had been modeled, what that would look like at a 50 to 60% completion of renovated units, where that would put equity multiple and IRRs.
Yeah, I mean, we modeled it out as we were going through the property. We felt like that from the modeling that our current business plan was the best business plan. So, I mean, that's kind of what our modeling reflects, as well as what the pitch deck reflects.
Great.
Jonathan, you said you was coming in pretty strong with, I think, 5 to 8 units being renovated per month. What is your vacancy rate on this particular asset?
There are 3 vacants right now. We anticipate getting up to 10, actually 10% vacancy at any given point, and then an added on 15% of extra economic vacancy.
Thank you.
And also want to point out, guys, that even though you're modeling a 5-year hold and you're modeling, a full rehab on the project, that the moment you reach your business plan, you're going to start reevaluating, and most of these deals get sold as soon as you reach that business plan. And that may be in 2 years, it may be in 3 years, it may be in 4 years, but seldom are we seeing these go full cycle. So you stop the renovation and start marketing the property as soon as the market helps or tells you that your business plan is complete. So if we are targeting, 18% and we get there in year 3, then we most definitely will be seeking broker's opinion of value and seeing if it's time to exit. Andrew also had a question he typed in the chat. What's the target average annual return?
Oh, it's the exact same. It's 17.5% because we're doing the refinance and then the I don't know why that took me more than like 2 seconds to think about.
You got too many deals going on, Jonathan. That's why. Just kidding.
Misi asked, what is the average rent right now? And is the 54,000 income for the Houston market or for the trade area?
I'm sorry, could you?
I gotta look at the average rent currently. I don't remember that off the top of my head.
And the median income?
Median income is 56,000.
Yeah, I saw it on the slide, it was 56,000. I just wasn't sure if that's for Houston market, which because the title said Houston market, or it's for the trade area. Because I heard that Houston varies by block, some areas.
Yeah, for sure. No, this is by zip code.
Okay, thank you.
It's actually 54,696. Whatever, same thing.
Okay. And currently, what's the is there GP shares for additional funds that other would bring? Because I know that you already have a few people on the GP shares for from a capital raising standpoint, and also like what would be like a significant enough share that would qualify for like GP spots and things like that. I don't know what's the structure you have in place now.
Sure. No, so you're asking what does the capital raiser get for the GP, correct?
In short, you can say that, yeah.
All right. Yeah. So we're reserving 30% of the GP for the entire $6 million capital raise. It's a relationship business. So I mean, if you wanted to raise like 500,000, that would definitely get into the GP. We're only looking at a 1.7 to 2.4 million of a capital raise. So,
Yeah.
I mean,
And I'll re-emphasize the first time we're working with private equity. So we're hoping that they come through, but we most definitely want to have a contingency plan, which is why we're having this phone call. And I will re-emphasize, in this business, it's first come, first serve. Whoever has their money in their hand is ready to put in a deal, they are in the deal.
When would you know about the preferred equities?
they're supposed to be getting term sheets back to us later this week or early next week.
Okay.
So it could be 30% of the GP for 1 to 2 million versus all 6 and change.
No, it's 30% for all 6.
Got it. Okay, I didn't know if the preferred equity would take a GP position or an LP position.
They'll take LP. Well, it's actually it's actually neither really.
Hey, Jonathan, could you speak a little bit about your group's track record for us? Like the deals that you are currently in, where the markets you're in, how you're performing on those deals. Do you have any other deals in Houston? Anything
Sure,
you can elaborate on there?
So it's a kind of a complicated question. It's not really, but so are you talking about Fairwinds or Fairwinds with Jim, Kimra, and Julie?
I'd say just your key principles. So without Jim, without Julie.
No, they are key principles.
They are key principles.
Oh, sorry. Just I guess the core, there's 4 of you, the core 4?
Yeah, absolutely. But in this deal, it also includes Jim, Kimra, and Julie. So that they're very much so a part of it. So for Fairwinds, we have 451 units under management. The GP management, 104 plus 16, and then 23 are all going full cycle within the next 3 months. And we don't have any experience in Houston, which is why we brought in specifically Kimra, who has operated several deals in the Houston area, which have all gone full cycle.
Hey, Jonathan, Kimra is here. So if anybody has any questions for Kimra, I would want to tell everybody that Kimra is a rock star on this. Keeping in mind that your management company, this gal has been in the business for 40 years. She knows how to get in and get out of transactions. She's been through full cycle. She has been up and down in this, in the, whether it, 2008, right? We had some issues. So she's run through these types of environments. So I'm speaking for her. She is, she's a partner of ours, and that's where you want to hang your hat, because at the end of the day, it's the property managers that are going to execute your business plan. Okay. And we're all on board with how we're going to execute this. So I don't know if Kimra, you want to say anything, but this is the power of this team right here.
I'll say hi. And I'm here for any questions. Yeah.
Yeah, Kimra, I was wondering, because I've seen you around in quite a few, not podcasts, but meetings at least. So yeah, I heard great things about you. And I was wondering, from a sponsor standpoint, how active are you going to be involved? I don't know how many assets that you're actually involved in right now, and like how does your bandwidth stretch? Because I actually have a question for, I guess, most of the sponsors. Because I know I see you guys in a lot of the deals, but it's only one person. How do you get get the information loop and
Yeah, so I actually have a couple of companies. I have a full infrastructure of 25 corporate team members and 80 site team members. We have a bench in Texas and Houston as well. In fact, on this particular deal, what's exciting is we sold out in Texas in 2019. But actually, let me back up. I'm currently active on 17, I'll have to count because we just had 2 more, 17 active deals right now. I've been LP on a total of 28, 29 full cycle deals in the last 10 years, but I've also managed as many as 10,000 units at a time, pretty much for the last 10, 12 years. But I've also managed up to 400 properties because I spent a lot of time in the institutional world. So I have a pretty strong infrastructure from administrative and property operations, asset management, construction management. We have all those departments already currently. So we mobilize in many just about any market because we've worked in those markets. But right now we're in 7 states, or actually we have 2 acquisitions next week, actually third-party acquisitions. I'm not on those deals, but we're a third-party manager for those people. And we're moving into 2 new states next week. Houston, I went to college in Houston a long time ago, and got my start in Houston. I lived there for 11 years. And I've had properties there since I grew up, as recent as selling about 2,000 units in 2019. And since then been looking to get back into Texas. So I'm really excited on the country club deal. It's almost textbook for a high-end repositioning. It is just a classic, a great location, especially for the targeted demographic that we're going to be going after. And we have construction management, boots on the ground there. We have our manager and our service manager that's going to join as those roles were actually regional level positions for us for many years in Texas, but they're going to rejoin us as the manager and service manager of Country Club in those roles. And they will operate the properties and help us get those leased up as we continue to build our footprint in Texas. So we're getting incredible regional level support at a property operational expense level. So that's really exciting with people who've done this with us over and over and over again, over the past 10 years. So that's really exciting for the deal as well.
Kimra did not mention that she's done $120 million in construction. That's
Right.
huge, you guys. And so she knows how to implement this and execute it. So
yeah. And the key to that is you can have a construction arm, but if you, my major was architecture turned business, but so that got me, ready to go in this industry. But if you have a construction management arm, you can have a operations arm, but you need to have a construction management and operations arm that are cohesive and work together. And that's why we're so successful, because it's all about timing and making certain we can deliver the product as fast as we can deliver it, because we're going to lease them as fast as we can. And that needs to happen quickly in order to deliver, over deliver on your business plan. So we got the team for it. Mm-hmm.
Thank you, Kimra.
Thank you.
I'll even add on to that, the who's going to be the main manager for the property. Like, she blew me away when I was down there and I met her. You could tell that she has so much experience, and it was almost like just getting back into it. She did a great job in getting us around the property into the units for all of the due diligence. Like I was blown away by just that short period of time of meeting her. So.
Yeah, she just came by to say hello, but she jumped right in and was knocking on doors and working. Yeah.
Mm-hmm. More questions?
What's the break-even occupancy during the stress test on this? And also, kind of a follow-up question is, one thing about Houston, it's more of oil and gas. So I guess a lot of Texas as well. With real estate having longer term hold and new energy, and also administration as well, current administration, potential job loss related to the oil gas industry, maybe going not as popular, So I wanted to understand more about the break-even occupancy from a stress test standpoint.
Well, before we let the number guy jump in, I'll point out the community sits in a healthcare hub. So it's not going to be dependent upon that. I mean, it's not far from the Exxon, national international headquarters. That's right up at Woodlands area, but it's right surrounded by healthcare, which is fantastic.
That's great. Yeah.
Yes.
Yeah, and I don't remember the exact numbers, but I had read, and I can get those, but I think that oil and gas, Houston still has this image of being an oil and gas dominated economy. And I think that the number is less than 20% of all jobs in Houston are still oil and gas. And it had at one point reached a low of about 10%. And so Houston's economy is much, much more robust than it was prior to 2008.
I would agree with you. They've really diversified. They knew that, you know, when they got hit by some of those hurricanes, that there was not a lot left for people. So they've really focused on trying to diversify it and get more and different types of businesses to move down there. Steve Chan probably can address that. He lives there.
Yeah, in the 80s, Houston learned a lot after coming through the 80s. I know that's probably before most of you were even born, but I saw so many, grown men executives out of shell and all just, absolutely lost their entire life savings. Houston really took a hit in the 80s, and they really started working on bringing other businesses in, but there is still a strong component. I mean, the energy corridor is there, but this property, it's 134 units, and we're surrounded by healthcare. So, and school and a really good school system. So we have the ability to not even have to tap into that. Meaning that energy.
My name is Nelson. I have a question. How much is the acquisition fee again? And how much are the GPs putting into the project?
3% for the acquisition fee and 10% coming from the GPs.
Like how much is the acquisition fee right now?
It was on the capital breakdown slide. I don't remember the exact.
The dollar amount?
328,000.
Got it. Thank you.
And I know there's a few people on this call that are focused on kind of bring the fund to the deal along with other responsibilities. So since it's a 506C, let's say if I establish a separate fund with a few other people or another person, and we, let's say, bring a significant amount, would that give us the opportunity to provide the opportunity to non-credit investors, or does it have to be a credit still? I don't know if it's a legal question you can answer.
Right now, just assume accredited investors. I think there's not enough time between now where we could probably legally wrangle our way into unaccredited investors on this deal. So I would just say leave here assuming that your investors need to be accredited.
Thank you.
I will address that too, because we don't have the mechanism right now, but there's someone else that's on the call. Badri is on the call right now. If you have a number of non-accredited investors, sophisticated investors, and they were interested in this deal, I would encourage you to get on a call with Badri and see if there's a mechanism that they already have existing within their fund that might be able to take unaccredited investors. But that would be my only suggestion. I don't know if it's possible.
Hey, Jim, since you brought this up, I'm afraid the answer is no, because our fund is a 506C fund.
Okay.
And we can also invest in only 506C fund. The other alternative is for them to create I don't think there is any answer for you, because even if you create a 506B fund, you cannot invest in a 506C deal from a 506B fund. So the short answer is unfortunately no, though I hate to say no to anyone.
Yeah, thank you, Badri. I appreciate that. Does anyone on the call have a CF set up already? Okay, I'll take that as a no. So yeah.
Can you repeat that question, Jim?
If anyone had a CF fund set up,
Crowdfunding.
A Reg CF.
Reg CF.
So if anyone did, then that would be an opportunity to potentially invest through your fund, but it doesn't sound like anyone has one set up yet. So the easy answer is no, it's accredited investors. But you know, if you know someone in your network that would be interested in investing through their own fund, or through, if you know someone who has a CF, then feel free to reach out and connect with us. We'd be happy to talk to them and present the deal to them. And that might be a way for you to get other funds into the deal, but we're not counting on that. And we're not going to try to jump through too many hoops to make that happen. And I do want to remind everyone, because some people came in later, if you want a copy of the recording, make sure you drop your name into the chat so that I can send you a copy of the recording.
Perfect. Thanks, Jim.
Yeah.
I would like a copy. And
Okay,
I got a couple of questions. So the core four, could you guys please let us know for how long have you guys been working together? And you kind of, I think Jonathan kind of mentioned how many units they have worked together in. And I'm also would like to know what the process is for LPs to qualify for 506C, how the process would look.
Yeah, so to qualify for a 506C, you have to be an accredited investor, meaning that if my memory serves me right, you have to make individually $250K in your W-2 job per year, or $300K, I think, as a couple, and or you need to have a net worth of more than $1 million, or $1 million or higher in your net worth. And if you don't know what your net worth is, you definitely need to start to keep a PFS, a personal financial statement. The first time I had to do one, I had no idea I was an accredited investor. I thought my net worth was $200,000 or $300,000, and the first one I did, it was 1.2 million.
Perfect. I know there would be a third party that the GP would have to, sorry, the LPs would have to go through to prove that they are accredited. So I was more asking about what, if an LP asks me what's the process and how would I qualify, I just would like to know how that would look for them.
Yeah,
Okay.
so for that, there's a couple different ways, but more specifically, there's third-party website verifications that you can go through, or a letter from your CPA that says that you meet the requirements for the SEC for an accredited investor.
Okay, so it would be their responsibility to do that?
That's so in order to go through our portal, yeah, basically that's what we would ask from an LP was, hey, have you done a third-party verification, or can I see a letter from your CPA?
You know, we could
Deepa, if you want to message me, we are happy to introduce you to a third party who can verify this for $30, $40.
Okay, perfect. Thank you.
Adri Malinor. I think you'll figure out.
I got it. I got it. Thank you.
Yeah, thanks.
And there was another part to your question, wasn't there, Deepa? How long we've worked together? So we've been pursuing several deals together, this team, over the past year, and we've gotten very, very close on a couple. But you know, I think this one is, you know, the furthest along that we've gotten, and so we are very confident that this one's going to close. You know, we've got all the pieces in place. The team's been working together for quite a while now, so I think we've gotten to a very comfortable position as far as how much we know each other, and collective experience on the team. I think one of the pitch decks is, I think it says over 100 years, but I'm 63, and there's a couple of other people that are not quite as old, but been in the business a long time, and so there is a lot of experience. This is not a team that was built in the last, or the experience on the team. These are not people that just came into the syndication business for the last year or the last 2 years or 3 years. I know there's a lot of internet stars in this business right now that have only been doing it for 2 or 3 years. And so that one of the strengths of this team is the fact that we've got a couple of graybeards that have been doing it for a long, long time.
And then
Perfect. Thank you.
more
And
specifically.
I shaved
to the-
mine, Tier. I shaved mine.
And then more specifically to the Fairwinds team, Jonathan and I have known each other for years. We've been partnering together for a couple of years now, to include a couple syndications prior to forming the Fairwinds team. Jaspreet is one of our newest members. He joined the team this year, but I think, Jonathan, you've known him for a year or two, right?
We worked together for a couple of years.
Yeah, and again, Vadim was on some of those teams that, or some of those deals that we did prior to forming Fairwinds. So
Thank you.
Hey, Jonathan, Mark here. I think someone asked you about, how you doing? I think someone asked about the stress test, and looking at the capital stack and the preferred equity. You know, the common equity sits at the top. I'm looking at when the common equity, like what economical vacancy would occur to have where the common equity wouldn't get paid, because it would fall down the stack in terms of, like, you know, the riskiest is at the top, then the preferred, whatever they're preferred, so they'll get their return unless it's not there. But yeah, I don't know if you could speak to that, and like what would that look like, worst case scenario, where, you know, there wouldn't be enough for the common equity side, I guess.
So for the common equity side, I was looking at neighborhood of 31%. But in year one, the common equity shouldn't expect to get paid. And then in year two, it will be low to no cash flow for the common equity in year two. We expect there to be cash flow in year two, but in case something happens, we're saying that most likely beginning of year three is when the common equity should start. And then once the stable, the stress test is 40.1%. Does that make sense?
Yep. So for the common equity side, it's really, I mean, you're looking to get this done quick, kind of exit as soon as possible to provide the returns. I got you.
Yeah, like I said, we underwrote for out to 5 years. A lot of the returns that we have in this presentation is based on a 5-year exit. But that doesn't necessarily mean that we won't reevaluate and determine that there could be higher potential returns if we exit sooner.
Is there any government subsidized residence right now, or any apartment complexes in the very close proximity that are?
I might have to, Kimra, I don't remember if we saw anything in terms of government subsidies currently during our due diligence.
Yeah, I don't recall there being any at this community. If there is, it's only 1 or 2, and they would only be grandfathered in, and we would work on an exit plan. But yeah, this is the Spring Cypress Station market is a really solid market. There's nothing really nearby that's assisted. And collections are pretty strong at this property already. Not too much delinquency.
Yeah, I mean, even though we're doing a what you would refer to as a heavy lift for a property, this property is already currently performing. I mean, there's the high occupancy. I think the current property management company leaves a little bit to be desired in terms of how they're operating the property. But they're collecting rent, there's high occupancy. It's just a lot of their stuff is below market, even for the current condition of the property. And so what we're looking to do is obviously take the property to a higher level and maintain the current occupancy rates as well as collection rates, which will allow us to reach the stated returns for the investors.
I think the main point here being that we are trying to help this property achieve competitive rates as much newer vintage assets in the neighborhood by bringing the amenities up. So the playground, the fitness center, the washer dryer and units, those are the higher amenities that don't exist right now. And so it's currently competing at the 1970s, 1980s vintage rates. But once those amenities come in, that's when those rates go up and allow us to bring to market the higher rents and change the asset, sort of valuation in the market, better tenant class. And so it competes with the newer vintage assets for market rents versus competing in that 70 to 80 vintage.
Yeah, and I want to speak to that also real quickly. When you're running a property, when your occupancy gets above 95%, that typically means that your rents are low. Or there's so little supply in the market. And so there's lots of opportunity. With only 3 vacant units, that tells you that there's a lot of opportunity there. But the other thing about the level of upgrade, Kimra presented us with 3 different business plans. We could go with, just really kind of maintaining where we are and trying to run this just super efficiently, or we could go with a mid-level upgrade, or we could go with a high-level upgrade. And the reason we chose the high-level upgrade is there's lots of opportunity there already. It's a proven business plan. We already have competition that's already doing this. So we're not trying to set the market or to be the highest in the market. We're just trying to achieve what's already there. And this is the business plan that needs to be implemented to get to that level. And so it's already a proven business plan.
Are you looking to for a completely different tenant profile? Like, is this or are some of them? Yeah. Okay.
Yes, we are. It's going to be a repositioning, a higher economic demographic. The finishes are going to cater to that, comparable to the other comps, such as stone countertops, new cabinetry, wood-inspired flooring, some trendy contemporary backsplash, along with the exterior amenities that Jaspreet mentioned that are targeted for.
And the technology packages, right? The technology package for keyless entry and smart thermostats and all that stuff is all targeted to be able to attract that higher tenant base, higher class tenant base, higher quality tenant base, and to really bring those medical staff in to attract those medium-term renters, to have traveling nurses and executives that are traveling to the neighborhood to really come there, because now you have those amenities that they look for, to not be able to fumbling with keys and know that they can set their thermostats before they get in there, have better quality LED lighting so their utility bills are lower. All those things are being done to not only make the property more efficient, but also make it easier for the tenant base to come in and pay the higher rents, because they know that their utility packages are going to be much lower on the costs monthly basis.
And to add into that, I think Jonathan briefly mentioned it during the budget, but with the package locker that we're looking to install there, I mean, that's something that your higher end tenants are looking to have available at the property. But also what's not really, you can't really take into account in terms of the underwriting is the benefit that does for our on-site property management team. Now they're not having to deal with packages. It's really just easier for everyone. You don't have to deal with potentially losing a package from your property management team's perspective, or just fumbling around accepting the packages and then trying to get them to the tenants when they come to pick them up. But at the same time, they have the added benefit of just being able to go to a box. They'll potentially pay a monthly fee for that, which obviously is a win for us, because now you had an added fee where we can add on to the total income for the property, which is not included into the underwriting. And it's really a win-win situation across the entire property and management team to investors.
Yeah, to give you an idea on those package lockers, we installed just over 40 at 40 different communities pre-COVID, and they were really a big hit. It was folks weren't really doing those too much at multifamily. They were just really kind of ramping up, unless it was a brand new community, but we were doing those on our value add repositionings. Now post-COVID, everyone orders online now. So it actually turned our offices, our management team on site into delivery, package managers. But what they love about that is the convenience of being able to help themselves. I mean, we allow self-guided tours, the whole technology component of that. We don't lose the warm and fuzziness of the human touch, but we do bring the newer technology to the resident and prospect base that they're drawn to and looking for to make their life more convenient.
So a couple of private messages. So just to go ahead and bring this up for the benefit of everyone. Typically people are asking about RUBS in a situation like this. Jonathan, do you want to address that question?
I didn't see the question.
No, it was a private message to me.
What's the question?
RUBS.
RUBS. So the property, you want me to take RUBS?
Sure. Yeah.
Yeah, go for it. Then I was looking at you. So today the property does rub based on, they use they actually use the same company that we use to rub. However, their pass-through percentage, they have a really high CAD, which is, it's called CAD, it's a common area deduction. So they're not actually recovering as much of the water and sewer that they can. So we're a little more aggressive. We follow, of course, the Utility Regulatory Commission guidelines for Texas, and we will be able to improve on the collection from residents on utilities.
And was that part of our underwriting and for other income?
It is, but when you're looking at the underwriting, keep in mind that while it's layered in to be able to increase the percentage of collections against your utility expense, it's not a direct correlation because we're installing all these water saving devices and these other things. So what happens is our utility expense will drop, but the revenue for that also follows suit and with the same curve because the expense is lower. But it is baked into the underwriting and budget.
Yeah, and the elimination of the laundry room, I don't think we mentioned that. That'll be an opportunity area for us, and also that part of the other income is the washer dryer installation, adding that to the units, and that's a big addition.
Yeah, we're actually going to eliminate the large laundry community laundry center, clothes center, which overlooks the swimming pool, and we're going to make that a really cool fitness studio. There is another really small laundry, like 2 washing machines and 2 dryers, I think, in there. We'll have a transition period for that. We'll determine if we're going to keep that in place or not for people who have, is something that happens, or they just want, they've got 6 loads and they want to do them faster. We will have a transition for that smaller space though.
And also I have several people that want to underwrite the deal. So we will provide a link or a Dropbox or a shared drive so that you guys have an opportunity to see the pitch deck and also to underwrite the deal on your own if you want to.
And if you just want to invest by yourself, we'll take that as well.
We won't say no.
That's right.
Have you guys underwritten this with a complete $6 million raise, like without the preferred equity, or?
That is not where the current underwriting is done. It's underwritten currently with the preferred equity in there.
Can you bring it, Mark?
No, I was just wondering if
we could do it.
Well, I'm just saying 12 of us at 500K each, right? Is that what it would be? I'm just saying
that's a lot of people.
Yeah. Yeah.
Well, if you know 12 people that want to bring 500K each and they want to provide the private equity, then let's talk about that.
Let's do it.
Put
Yeah,
you in the
yeah,
private
right,
equity
right.
position.
We won't say no. Chris, looks like you have a question. What do you got?
Yeah, I just had a question in regards to the common equity distributions that you guys plan on giving out in relation to the hold period and the actual business plan. So just for some clarity, is the intention just based off the value add nature of the project to withhold distributions up until year 3 and then start giving out those distributions for the subsequent 2 years up until year 5?
Yeah, I think anytime there's excess cash on that NOI line, the intent is to distribute that to the appropriate structure. So we're not intentionally saying, no, we're going to hold off year 1, 2, and then start distributing year 3. As soon as there's money there, if we outperform the business plan and there's excess to distribute, then it will be distributed.
Gotcha. Thank you.
We were conservative in the underwriting for the timeline of the renovations, spread over a couple of years. I can tell you from a capability standpoint, we've done 2,000 units in 10 months. We could certainly handle 134. But the timing, we want to balance it with keeping the occupancy, in the 90s. But yet, move them quickly. So we were more conservative in how we looked at the timeline of the renovation. Therefore, that's what Jonathan was referring to of potentially the first 2 years not having a distribution.
But also,
yeah.
But also, we are starting off with a bridge loan. And so with that, that's short term. And the guys are anticipating a return of capital. I think it's 65%. So that is the most opportune time for you to look at your business plan and see where you are. And you can refinance into longer term debt. But also with the way the market has been just on fire, if it continues at this pace, we're going to have to really seriously look at selling the property, because if this pace continues, we'll have the opportunity at that at the time to refinance to potentially sell, because we will have executed the business plan. So all of that, the intent is always to distribute, and as soon as you hit your business plan, put that in front of your investors and let them know, do you want to sell or do you want to hang on and ride this out? And also want to make clear that, because I don't recall if we did, that the private equity piece is bought out at they have a cap. So they're not there. Potentially we have the opportunity to get them out earlier once we meet a certain return for them.
And we like it that way.
Is that return the 14 IR? What was the return? Okay.
Yeah, so it's in the slide deck as 14, but it could be between 12 and 14% based off what we're receiving so far.
Once again, Mark, if you have some high net worth individuals that want to take those guys out, well, we could probably put you on the GP. Just thinking.
So, so that preferred equity, they're not on the GP at all?
No.
What? Oh, okay.
Yeah, we're targeting soft preferred equity. So we don't want them to have controlling interest in the deal.
Gotcha. Okay.
And some of the lender terms are going to dictate who can come in as well. So we're trying to find the right balance.
When you guys underwrote this, you guys underwrote it at with the preferred equity at 90% of the total raise?
We did.
And that was based off and that was based off the terms that they offered. So in other words, they're the one that said, look, we'd like to come in at this number. So that's the number the guys used. We didn't push them to say, can you get us more? Can you get us more? So they felt confident giving us that number. So we'll see how they perform.
So how much can we rely on you guys to get us to close? How much, each of you? Andrew, what do you got?
I don't know yet. I'll let you know.
After the
Working on it.
Yeah.
All right, awesome. Mark, you got about 500 million right there?
500 million.
We
The
could-
co- the
500 to a
the
million.
common equity
500 million.
Yeah.
We can count on you, Mark.
for 500 million. Yeah, I wouldn't
No,
be in this call
500
right
to a
now.
million.
Yeah.
500 to a million. Yeah.
No, well, this
okay.
is, well, don't put my name yet.
They want to underwrite it. Yeah, they want to.
Of
Yeah.
course, of
We definitely want to
course,
underwrite it.
of course.
Like
Julie's
to
going
stress
in for
test
the
it.
sale. She's going in for the
Yeah,
sale.
but
She
you
can't help
you
herself.
have to
She's
want to
aggressive.
close. We want to
Wait.
have a close here.
Always be closing. Always be closing.
Always be closing. ABC.
Yeah.
Oh,
So guys, it's 2:09 so Central Time. So I want to be respectful of everyone's time. And a lot of people are going to want to rewatch the recording. So I don't want to make it an hour and a half. So if there's any other pressing questions that were not asked, please email the team. We'll get them answered for you and back to you. I'll leave it at that unless there's something that was really, really pressing that someone didn't get to ask. Okay, going once, twice, gone. All right, thank you very, very much.
Thanks, everyone.
Thank you, everybody.
Thanks, guys.
everybody. Thank you.
Thanks,
Really, really
everyone.
appreciate it.
Thank you.
Bye.